stop. Look at this number. The average American homeowner insurance premium jumped 21% in the last year alone. That's not inflation. That's not a typo. And in about 8 minutes, you're going to understand the machine that is quietly draining your bank account. And most people have no idea it's even running. Now, I know what you're thinking. Maybe it's just my state. Maybe I had a claim. Maybe it's bad luck. Here's the part people miss. This isn't random. This is a system. In the next few minutes, I'm going to show you the 3-step cycle that insurance companies use to raise your rates, even when you've never filed a single claim. At the 6-minute mark, I'll reveal the hidden player most people have never heard of, the one that actually sets the prices you pay. And by the end, you'll have a 5-step checklist to protect yourself before the next rate hike hits. But first, let me show you what happened to someone who thought they were doing everything right. Let's use real math. Say you're paying $2,400 a year for homeowners insurance. That's $200 a month, pretty typical. Now, if your premium increases 20% per year for 5 years, which based on current trends isn't crazy, here's where you end up. Almost $5,000 a year. You just doubled your housing cost on insurance alone. And here's the trapdoor. You probably won't notice it year to year. 20% sounds small, but this is how the leaking bucket works. Drip, drip, drip. And by the time you look down, the bucket's empty. And this is where it gets uncomfortable. I call this the premium spiral. And once you see it, you can't unsee it. Here's how it works. Step 1, the trigger event. A major disaster happens. Wildfire, hurricane, flood. Insurance companies pay out billions. In 2023 alone, insured losses from natural disasters exceeded $100 billion globally. That's not normal. That's a record. Step 2, the pullback. Insurance companies look at the math and say, we can't keep covering these areas at these prices. So what do? They either leave the market entirely, like what happened in California and Florida, or they jack up prices so high that only the desperate stay. In 30 seconds, I'll show you what happens next. Now here's where the dominoes start falling. Step 3, the squeeze. With fewer companies offering coverage, competition disappears. And when competition disappears, what do you think happens to prices? They go up. Not because of your claims, not because of your risk, but because there's nowhere else to go. This isn't a theory, this is math. Less supply, same demand, higher price. Econ 101, weaponized against your wallet. And step 4, the loop. Here's what makes this a spiral and not just a one-time hit. Higher premiums mean some homeowners can't afford coverage. They drop it. Now the insurance pool shrinks. With fewer people paying in, the risk per person goes up. So what happens next cycle? Prices go up again. The fuse keeps burning. And most people don't realize they're standing on a ticking system. That's the premium spiral. 4 steps. No escape. Unless you see it first. Now let me show you the hidden player I mentioned at the beginning. Because everything I just described, it's driven by something most people have never heard of. Let me ask you, what city are you in? Drop it in the comments. Because where you live now determines what I'm about to show you. Your insurance company, the one you pay every month, they don't actually hold all the risk themselves. They buy insurance too. It's called reinsurance. The stuff that would bankrupt them. Names like Swiss Re, Munich Re, Berkshire Hathaway's reinsurance arm. When reinsurance prices go up, your local insurer passes that cost directly to you. In 2023, reinsurance rates increased 20-30% in some categories. And guess what happened to your premium? This is the silent tax. You never see the invoice. You never get the explanation. You just get a letter saying your rate went up due to market conditions. Market conditions. That's code for the invisible company behind your company raised their prices. Let me tell you a quick story. I talked to a homeowner in Texas last year. Good house, no claims in 10 years, perfect payment history. His premium went from $3,200 to $4,800 in one renewal. He called his agent. The agent said, sorry, it's the reinsurers, nothing I can do. He felt like he was on a treadmill running faster, going nowhere. But it gets worse. Because the reinsurers aren't stupid. They see what's coming. Climate models, demographic shifts, infrastructure aging, and they're pricing that future into today's premiums. Did you live through 2008? Because that crisis taught the financial world one lesson: price the risk before it shows up on the books. That's exactly what's happening now. And here's the kicker. These reinsurance companies, they're some of the most profitable on earth. This isn't charity. This is business. And you're the one paying for their risk management. That's the hidden player. Reinsurance, the ghost in your premium. Now let's talk about what happens next, because this isn't a static problem. It's moving. And like dominoes, once it starts, each piece knocks over the next. Here's the chain I want you to see. Domino 1. More homeowners can't afford coverage. We're already seeing this. What bill increased the most for you this year? Let me know in the comments. In some states, insurance is now the biggest expense after the mortgage itself. Domino 2. Banks tighten lending. Here's what most people don't realize. To get a mortgage, you need insurance. If insurance becomes unaffordable or unavailable, banks won't lend. They won't take the risk of an uninsured asset. So what happens? Housing markets in high-risk areas start to freeze. Buyers can't buy, sellers can't sell. Prices fall, not because of demand, but because of insurance. Are you debt-free or leveraged right now? That answer matters more than you think. Domino 3. Government becomes insurer of last resort. When private companies leave, the state steps in. Florida has Citizens Insurance. California has Fair Plan. These aren't better. They're often more expensive, and they're funded by, guess who, taxpayers. So even if you're not in a high-risk area, you might end up paying for someone else's risk through your taxes. This is how risk becomes everyone's problem. Okay, now here's why you stayed until now. The 5-step checklist to protect yourself before the next cycle hits. I'm going to go fast. Screenshot this. Step 1, request a loss history report. This is called a clue report. It shows every claim associated with your property, even ones before you owned it. If there's an error, it could be inflating your rate. Free to get. Most people never check it. Step 2, increase your deductible strategically. Going from $1,000 to $2,500 can drop your premium 10 to 20%. But only do this if you have that cash in an emergency fund. Don't trade one risk for another. Step 3, bundle, but verify. Bundling home and auto can save 15 to 25%. But every year, unbundle the quotes and compare. Sometimes the bundle stops being the deal. Step 4, mitigation credits. Many insurers offer discounts for things like impact-resistant roofs, security systems, or updated electrical. Ask specifically, what discounts am I missing? They won't volunteer them. Step 5, shop before renewal. Don't wait for the letter. 60 days before your policy ends, get 3 quotes minimum. Do you trust your bank and insurer to give you the best deal without asking? That's not how this works. That's the checklist. 5 steps. Do them all, and historically people can reduce premiums 15-30%. No guarantees, but the math tends to favor the prepared. Now, here's what I didn't cover today, but I will in part 2. First, the 3 states where this crisis is worst, and whether you should consider relocating. Second, the exact questions to ask an insurance broker that most agents hope you don't know. Third, how to read your policy to find coverage gaps that could cost you everything. Here's the truth. What's happening in insurance is a wealth transfer. From you, to reinsurers, to shareholders, to the prepared. And the only question is which side of that transfer you'll be on. So let me ask you, would you rather hold cash or physical assets when this unfolds? Tell me in the comments. I'm not here to scare you. I'm here to show you the math. What you do with it is up to you. Part 2 drops next week. Don't miss it.